Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question.
All right, what do we got today? Can I pay my premiums for multiple years? How does that work? Yes, you can prepay your premiums. I don't know, many years, 10 years. I've had clients pay in advance 4 or 5 years. I've had clients pay 9 or 10 years, something like that in advance. You can pay for a pretty long time. Insurance companies will call this not surprisingly, a prepayment of premiums. And most insurance companies will offer what's called a premium deposit fund to allow you to get effectively, the way they look at it is essentially a discount on any premiums that you prepay. And the discount rate is based on the current market interest rates and changes monthly. Now, what they're actually doing is setting up, in effect, an annuity of sorts, and then what they're doing is paying interest on whatever the lump sum that you give them. So if you give them a large, let's say you give them $500,000 or $1 million or whatever, they're going to say, well, our prepayment rate is 5% or something. Some carriers run like really good ones like that. There's one in particular that will run these specials, is like, we'll pay you 10% APR. In year one, and then it drops to, 3 or 4 or 5 or whatever, to 5% or whatever is in subsequent years. That's still a pretty good deal. Anyway, so that's how they do it. You give them a lump sum, they pay you interest every year and deduct the amount that's due on your policy. It's essentially discounting the premiums because they're subsidizing, is what ends up happening, is subsidizing your premium for you. So all you really do is decide how many years you want to pay in advance and then get a quote for the total premium that's needed to fund your policy. And then you just send them a check to the insurance company, and that's it. Let's see. I have a bunch of money in savings. Can I put that all into a policy with just one payment? You can, with some some companies you can do that and get away with it. It's usually not a great idea to do that as a single premium, but it can be done. Some carriers can do that. They have, certain policy riders that make it, easier to do a lump sum payment if that's what you want to do. It can kind of mess with the policy dynamics and the design and the performance, over the long term, but you can do it. The short answer is yes. The longer answer is yes, but with some caveats. You could do it, and it could kind of, you could be giving up some performance on the back end, because when you put in a single premium, you got to do one or two things. You either have to have a really high base premium that's going to push up your death benefit amount, your permanent insurance amount, or you have to have like a large term blend. and then pay it off really quickly. And that's also adds some costs and some other things in the design. So you can do it if you really want. Sometimes it works out. Usually what I've seen is that you spread it out, it works a little better, but you could do it in one payment. Large with one exception. 1035 exchanges from one policy to another work really well as a lump sum. So a large lump sum payment is going to push the death benefit very high. And that's going to require, in a lot of cases, a large guaranteed level premium to sustain the policy going forward. The exception to this would be if the carrier allows like a really high term blend, like 9-to-1, right? In other words, $9 of term insurance per $1 of base whole life. If the carrier allows something like that, yeah, you can bring in like a lump sum and fund it, in year one and probably be fine. Spreading the lump sum out over maybe 4, 5, 6 years, maybe 7 years, maybe using an annuity or a premium deposit fund is going to work best and with a lot of carriers, because especially if they're limiting the term blend down. Unless you just don't mind having a large level premium payment, which is could be suitable for very large policies. Should I put all my savings into life insurance? Oh, probably not. If I'm being a life insurance salesman, yeah, put it all into life insurance. Realistically, probably not. It depends on your specific situation, but personally, I put substantially all my savings into life insurance. I do hold back some in my checking and savings account, but it's generally it's a good idea to keep at least a little bit of money in savings, either in a savings or checking account for short term, like small dollar emergencies. Alternatively, maybe carry a credit card with a generous credit line for emergencies, and then use your policy to pay off the credit line. But again, really depends on your situation, what kind of assets you've got, your cash flow, that kind of thing. So if you have the ability to access, $1,000, let's say, in cash or credit very quickly, when I say quickly, I mean within minutes or hours. Emergencies, it's like you got to come up with a little bit of cash in a very short period of time. $1,000 is sufficient for an emergency. Like you blow out a tire, you need a new tire or something like that. Something happens, you need to come up with a pretty, I'm going to say large sum of money, but you need to come up with some money fast. So if you have a credit card with a decent credit line, that would be a great use for something like that. The rest can be, accessed through life insurance, assuming, that's where you're keeping your savings. In any case, this is it's a decision that you're going to have to make for yourself. Unfortunately, it's not something anyone can tell you, myself included. It's because it's based on your current income, your current expenses, your lifestyle, what risks you're likely to encounter given your lifestyle, given your habits that you have, and your cash flow and risk tolerance and what you're most comfortable with, what's going to be most suitable for you, what's going to be in your best interest. And those things are going to be decided by you, what's in your best interest and what's going to be ultimately suitable for your situation is not going to be determined by someone else. Now there's, technically get into the technicalities of it. There are, rules and laws and regulation stuff that govern things like, the legal terms of suitability and fiduciary and what best interest and so on and so forth. But when you're making your own financial decisions, the reality of it is you have to decide what is in your best interest. So you have to be part of the conversation. It's not like, and it doesn't matter what the experts say or what professionals or whatever say. It's your money, and when you're making a decision about things, you have to be involved in the decision-making process. Nobody can make those decisions for you. That just can't happen. So you have to be involved in that, and then there's got to be some input on you about what's most comfortable, what you're most comfortable with. Anyway, I hope that answers the question. Thank you for sending these in, and keep sending them, and I will keep answering them. And I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, GENIX.com, and sign up for my daily email list.